What if I told you you could buy real estate with $0 out of your own pocket, and that I've done it over and over again? Most people think that you need a big bank account to get started in real estate. That's just not the truth. The truth is you need a deal, not dollars. In this video, I'm going to walk you through a fail-proof formula that I've used to buy properties over and over again with no money out of my pocket, so you can start to build wealth right now. So the number one excuse I hear from all investors is, I'd love to invest, but I just don't have the money. Listen, I didn't grow up rich. I didn't inherit anything. I had to learn this myself. I bought my first property in my 30s, and I can tell you, you do not need money. You need a good deal and the right team, because real estate is a team sport, and anyone can build a team. And when you find a good deal, then the money will follow it. Here's what most people get wrong. They're out there hunting for capital, and they don't even have a deal yet. I see this all the time. All you need to do is flip that way of thinking. Start with the deal and the money will follow. Otherwise, what does an investor even have to look at? Nothing. So here's my fail-proof formula on how to use $0 out of your own pocket. Find a deal. Now, how do you do that? If the deal sucks, then no one's going to fund it. And I have a saying, the bigger the brochure, the worse the deal. Most deals get done really quickly because they're really simple and really easy to understand. And that's the key. What is it that you see that no one else sees? But if you can find a deal and prove that it has cash flow upside and it solves a bunch of problems for everyone, maybe investors and lenders and landlords, then you're already halfway there. All you got to do is find it. So how do you find these deals and what do you look for? Here's what I look for. Number one, I look for rents below market. So what are the signs? We just bought a property where an owner lived in Florida and he was managing the property from Florida and he barely visited the property and he owned it for over 20 years and therefore the rents were way below market and he was trying to manage it from all the way across the country. Number two, poor management. An easy way to spot this is a property that has high vacancy, lots of turnover, maybe some evictions, and deferred maintenance. You can see this a lot of times from the outside. Also, if you go to the property, there are lots of signs that show up as a result of this. One of them, of course, is the actual rent roll itself and how many units are vacant. Now, one caveat, you want to make sure that the market is a good market when you're buying in a highly vacant market. And these deals exist at all times. Three is deferred maintenance. And I know you guys have seen this as you drive around a neighborhood or you drive around a property, you see the parking lots aren't great and the place needs painted and it just looks kind of tired and run down. Those are oftentimes great opportunities, and what it typically means is that the ownership doesn't have the cash to be able to do that work. That's a great way to value add something and make it worth a lot more money. And four, you look for motivated sellers. And who are they typically? In my experience, they're people that have loan maturities and interest rates have gone up significantly, like we're dealing with today. They could also be estate sales where the properties have passed on to the generation after them and they have no idea what to do with it. So there's lots of ways to find deals, and it's not easy, but it's also not hard once you get into the game. So those examples are what I call forced equity. So I know exactly what I'm going to do with the property before I buy it. That's extremely important because that becomes your story to raise capital for the investors. And that's how you turn your hard work and sweat into value. And that's what the investors want to see. So the deal tells the story. And if the numbers pencil, the investors will want in. The key is, what is it that you see? So I'll give you a quick example. For years, I just drove down the highway and I looked at billboards just like probably all of you. And then one day, we bought a property with a billboard on it. And I realized that most billboards have the two sides. Well, two sides being two ads. But then I looked into it. I hired a management company. Yes, there is a management company for billboards. And they told me that I could convert it to digital, which basically means a flat screen in the sky. So fast forward, I already had a billboard. I just replaced it with a digital. And what I learned is that a digital has 8 ads per side. So I went from 2 ads to 16 ads. And I don't need to tell you guys, when you increase the number of ads, you increase the number of revenue and you increase the value of something. So that was something I stumbled into by just being in the game. And that, of course, has turned into a whole business for me, which we started, which is called MC Media, where we're actually out finding billboards now. So once you overturn one rock, you just never know what's under it. But that's a great example of something that, because we were in the game, that we learned how to maximize the value. And of course, now we're raising money on those and we're buying these all over the country. So the key is to bring the story, not just the spreadsheet. So in the story story I just told you about the billboards, it sells itself. You understand it. It's simple, it's straightforward, and it makes sense. You go from 2 ads to 16. Of course, we got to keep them full and we got to collect the revenue, and there's a whole piece around that. But the story is simple. Those are the things that investors like to invest in. You're not pitching an Excel spreadsheet. You're telling a story. So that billboard story, that attracts capital. And it's true. And if you just repeat that model, you look for a static billboard or a two-sided billboard and you convert it to digital, that's the story. From there, of course, you got to keep it full and you got to manage it. And the ad rates, of course, are different in all the different cities and counties, but that's irrelevant because the story is 2 ads to 16 ads on one billboard that's already in place. So here's where the $0 come in. You structure a deal to bring in the equity partner or the down payment. So traditionally, people think that down payment needs to come from themselves or money that they've saved. That's not the case. What you do is you bring in the equity partner and you give them a piece of the deal, and then you keep a piece of the deal for finding the deal. They fund the down payment and you don't have to. That's where the zero out of pocket comes from.
Gold is near all-time highs, but appreciation isn't the only way to benefit. Monetary Metals, you could potentially earn a yield on your gold, paid in physical gold, without selling it. Here's how it works. When you lease your gold through their platform, pre-qualified companies pay to use it under strict guidelines, like renting out real estate, but with gold. Instead of paying to store your metal, you may earn up to 4% annually in gold. You stay in control and you can choose which leases to participate in. Monetary Metals handles the due diligence, lease terms, and all the administration. Thousands of investors use this approach to grow their gold, not just sit on it. Visit monetary-metals.com/Ken to learn more. Leasing gold involves risk and returns are not guaranteed. This is not an offer to buy or sell securities. Please review all risk disclosures at monetary-metals.com. Visit monetary-metals.com/Ken to learn more.
2, you find a lender that wants to lend on the asset, and that becomes the collateral, whether it's a house or a billboard or whatever it is, it doesn't really matter, but a lender will lend a certain percentage against that, and then the balance, of course, is the equity. And you're the deal maker, the asset manager, the one that's going to do all the work and the one that's going to pull all this off, the one that's going to manage the team and the one that's going to report to the investors, and the one that's going to make everyone a bunch of money through the value add creation of forced equity. You exchange sweat for equity. No money out of pocket, but a piece of the upside. So let me give you another real example. One of our earlier deals was a 116 unit apartment building. The rents were low, the tenants weren't being screened, there was high turnover, the expenses were high, they were spending a lot of money on marketing because they had a lot of vacancy, so their expenses were up and their income was down. Therefore, their net operating income, or their income minus expenses, was down. And of course, when a property is underperforming, they can't pay their bills and there's deferred maintenance that continues to add up. So we found a deal and packaged it and sent it to private investors, showing them what we were buying today and, more importantly, where we were going to take this property from a value standpoint. So they brought the equity, we got the loan, and then we, of course, handled the operations. And it took a couple years. It takes a while to turn around a property like this, but again, we're playing the long game. We're using the banks and other people's money to our advantage. So in that deal, there was no money out of pocket, just a great deal. And a few years later, we refinanced, pulled out the equity, and at that point, we had infinite returns. Because we had created the value, the bank was now lending on the future value that we had created based on the poor management and out-of-state ownership and all the things we already mentioned. In a sense, you're just making the property perform better. And guess who likes that? The tenants like that, the banks like that, the neighborhood likes that. It's a win for everyone, and more importantly, for your investors. This is what I say. The return on hustle is infinite. Here's why this works. Even in today's market, capital is still out there. Investors are looking for operators to solve problems. They're looking for operators with deals. That's how the system works. Lenders and investors make money when they invest with people like you. And banks, they're still looking to lend on good properties with, of course, good operators. And more importantly, you're solving problems, and that's how you get paid, and that's how everyone gets paid. So what kills deals? And we just went through this in the last cycle. Overpaying, poor underwriting, emotion, or just having the money to buy something because you created a fund. We've seen this over and over. Just because you've got the money doesn't mean that you should buy. And what makes deals? Fundamentals, cash flow, and teamwork. So here's the mindset shift that I want you to take. Stop asking, I can't afford real estate, and start asking, who can I help by finding a great deal? Because the moment you stop focusing on what you don't have and you start focusing on what you can find, then you become valuable. And when you're valuable, people will start to partner with you. I just made a video with Robert Kiyosaki on if we lost it all today, what would we do to make it all back? You can watch that video here.